Um, Basically, going forward as BPCL, we have plans to basically expand our business. There is a particular value chain in which we are present. You know that BPCL is predominantly a midstream, downstream company, that is refining and marketing company. Now we have plans to see that, when we expand into upstream and also, expand downstream of downstream, that is into petrochemicals and all that. So this is what basically, we have in our mind. By expanding, in our value chain, we feel that every notch in the value chain is going to give us some revenues. So that is one, large expansion plan that we have. And parallelly, in addition to this oil value chain, we are going to look at gas value chain. We have already started building up that value chain, and then parallelly, simultaneously, we would be looking at the other, areas like renewables and all that.
Okay.
Now, going forward, we are now doing somewhere around 35 million metric tons of sales as far as oil is concerned, and maybe close to 30 to 32 million metric tons of refining capacity that we have. So by 2021, 2022, we are expecting that it will be somewhere around 50 million metric tons of sales and 50 million metric tons of refining capacity. So this 50 and 50 together should take us to somewhere around 250 as our market cap. So this is the large plan that we have. In sum and substance.
Right.
In addition to that, we will be looking at global opportunities, and we will be looking at going global.
Right.
So this is
Right.
in short. Yes.
So the other thing is that your company stock has been doing pretty well last couple of weeks and months, and if you were to look at a longer term, say 5-year, phenomenally it has gone up and added value. One part which the analysts on the street are very happy about is the strength in core margins. What to your mind are the factors which are responsible for such strength in core GRMs and margins for your company?
So we have been consistently upgrading our refinery facilities. Now, recently we started basically expanding our refinery, especially in Cochin. This is one single refinery location where we have spent around 16,000 crores and completed the project within the cost. And this has been fully now commissioned. Now with this commissioning, with the secondary units, the complexity number of the refinery goes up. When it goes up, your GRMs basically improve. That is going to give you better profitability in terms of numbers. So this is one thing that we constantly do. And the second thing that we are doing is looking at constantly improving our market share in the marketplace by way of coming up with offerings which are basically non-fuel in nature, which can basically attract the customers to your retail outlets.
So better product mix and better Nielsen complexity of your expanded capacity at refineries, but overall also refining margins for Asian refineries are edging higher. Singapore GRM is $8-9 now. Do you think there's further upside scope for BPCL on the GRM front outlook?
Yeah, with all this project that we have recently commissioned, now we should be looking at where we were. Let's say last year we did about 5.26. Now we will be looking at somewhere around $6.5 to $7.